Somewhere in North America, right now, tens of thousands of trucks are making a decision. Not a dramatic decision. Not a headline-grabbing decision. Just a quiet, calculated, financially ruthless decision about which road to take across the border. And that decision, repeated hundreds of thousands of times over the past 12 months, has just redrawn the map of continental trade in a way that no tariff, no executive order, and no political speech could have predicted or prevented. Here is what the mainstream media is telling you. A bridge lost some traffic. Truckers found a cheaper route. Logistics companies optimized their costs. Story over. Here is what they are not telling you. For 90 years, a single privately owned structure controlled the most valuable commercial corridor in the Western Hemisphere. Not a government, not a treaty. A family. And the tolls they charged were not set by competition or regulation. They were set by the simple, brutal logic of monopoly. $27 per axle. Take it or leave it. Because for 9 decades, there was nowhere else to go. Then something shifted. Not overnight. Not with a press conference. But in the first 3 months of 2026, 531,732 trucks chose a different path. And 496,796 chose the old one. The gap is not closing. It is widening. The media calls this a logistics story. A cost efficiency story? An infrastructure story. I am going to show you why it is none of those things. This is a story about who actually controls the flow of $3.6 billion worth of goods every single day. It is a story about a 90-year monopoly quietly dying. It is a story about a new bridge that powerful people do not want opened, and exactly why that terrifies them. This is not about traffic. This is about power. To understand what is happening right now, you need to stop looking at the headlines and start looking at the timestamps. Because this story did not begin with a political speech or a tariff announcement. It began with a number that almost nobody noticed. Early 2025, inside the offices of the Federal Bridge Corporation Limited, a data set lands on a desk that has not looked like this in recorded history. For the first time, commercial truck crossings at the Blue Water Bridge connecting Sarnia, Ontario to Port Huron, Michigan, are tracking ahead of the Ambassador Bridge on a sustained month-by-month basis. Not a spike. Not a seasonal fluctuation, a structural shift. The kind that logistics analysts flag with 2 words, permanent reallocation. No press release is issued. No government statement is made. The numbers are quietly confirmed and filed. By March of 2025, the Federal Bridge Corporation makes it official. Blue Water Bridge has surpassed all other international crossings in commercial traffic volume. The announcement is 4 sentences long. It is buried beneath 37 other news items about tariff negotiations and border security. Almost no one outside the freight industry reads it. The full year numbers arrive in early 2026. 2.1 million truck crossings at Blue Water, 1.9 million at Ambassador, a gap of 200,000 crossings over 12 months. And the first quarter of 2026 confirms it is not reversing. 531,732 at Blue Water, 496,796 at Ambassador. The math is not subtle. Then in January of 2026, a different kind of pressure enters the picture. The Trump administration begins publicly questioning the legitimacy of the Gordie Howe International Bridge, a $6.4 billion crossing being built to modernize the Windsor-Detroit corridor. The framing coming out of Washington is provocative and carefully worded. Why is Canada building a bridge on American soil? Why does this deal benefit Ottawa more than it benefits Michigan? Ottawa does not respond with anger. It responds with facts delivered in the tone of someone who has already done the calculation and knows exactly where they stand. Prime Minister Mark Carney outlines the structure plainly. Canada financed the entire project. Ownership is shared. Both nations contributed labour and materials. Michigan receives 50% of net toll revenue after Canada recovers its investment. The agreement was signed by a Republican governor, reviewed by federal channels, and supported by a presidential permit issued by the United States State Department in 2013. The facts are not in dispute, but the narrative is being contested anyway. And here is where the timeline becomes genuinely important. Because as of April of 2026, the Gordie Howe Bridge has not opened. This is the 3rd delay on record. Earlier projections pointed to a spring opening. That window has passed. 3 delays. $6.4 billion. A corridor carrying nearly a quarter of all merchandise trade between 2 of the world's largest economies. And the bridge is still not open. That is not a construction story. That is a pressure point. Now I need you to stop looking at the surface, because everything you have heard so far, the traffic numbers, the toll prices, the political statements, that is the visible 10%. What sits below the waterline is where this story actually lives. Let us go back. Not to last year, not to the last administration. Let us go back 90 years. The Ambassador Bridge opened in 1929, built by private investors, financed by private capital. And from the moment the first truck rolled across it, the corridor between Windsor, Ontario and Detroit, Michigan, became the most commercially dense border crossing in the Western Hemisphere. The automotive industry grew up around it. Supply chains synchronized themselves to it. Entire regional economies organized their logistics around the assumption that this single structure would always be there, always be accessible, and always set the terms. For 90 years, it did exactly that. And here is the detail that mainstream coverage consistently glosses over. The Ambassador Bridge is not a public asset. It has never been a public asset. For the majority of its operational life, it was controlled by the Moran family of Detroit, a private ownership structure that gave a single family effective control over the primary gateway for an estimated 25% of all annual trade between Canada and the United States. Think about what that actually means. Not in abstract terms, in concrete financial terms. A private entity, accountable to no electorate and subject to minimal competitive pressure, sitting at the centre of a trade corridor processing billions of dollars of goods every single day. Setting tolls not by market competition, but by the logic of a captive customer base that had nowhere else to go. $27 per axle. For decades. That is not a market. That is a toll booth on the only road out of town. Now look at what the Gordie Howe Bridge actually represents. And I want you to look past the engineering specifications and the ribbon-cutting politics. Canada agreed to finance $6.4 billion, not just for a bridge, but for customs plazas, highway connections, and supporting infrastructure on both sides of the border. In return, Michigan receives joint ownership and 50% of net toll revenue in perpetuity after Canada recovers its initial investment. Canada spent $6.4 billion to break a 90-year private monopoly on the most strategically important commercial corridor in North America. That is what this is. But here is where the iceberg goes deeper still, because this corridor does not just carry sedans and pickup trucks. It carries the physical components of the battery supply chain for North American electric vehicle production. It carries aluminum and steel alloys used in aerospace and defense manufacturing. It carries semiconductor components moving between Canadian and American facilities that are embedded in products shipped globally. When you understand what is actually flowing through this corridor, the political reaction from Washington stops looking like economic nationalism and starts looking like something more specific. Canada holds the third largest lithium reserves in the world. It holds significant nickel and cobalt deposits, the materials that define who controls the next generation of energy storage and electric mobility. The Windsor-Detroit corridor is not just a crossing for legacy automotive supply chains. It is increasingly a critical artery for the materials and components that will determine industrial dominance in the 2030s and beyond. So when powerful voices in Washington begin raising questions about who should control infrastructure in this corridor, the question worth asking is not about bridge ownership. The question is about what flows across it, not trucks, resources. There is a particular kind of strategic miscalculation that only becomes visible in hindsight, where the pressure applied to weaken an opponent ends up accelerating exactly the outcome the pressure was designed to prevent. What has unfolded in this corridor over the past 18 months is a case study in that miscalculation, and the receipts are extraordinarily clear. Start with the tariffs. When the Trump administration imposed 50% duties on Canadian steel and aluminum, the stated logic was protection. Protect American industry. Strengthen domestic supply chains. Reduce dependence on foreign inputs. What actually happened was the opposite. Businesses operating on margins that were already under pressure from post-pandemic cost structures suddenly faced an additional layer of unavoidable expense. And when every line item becomes a survival question, companies do not absorb costs. They eliminate them wherever they still have the freedom to do so. The Ambassador Bridge toll structure, $27 per axle versus $7 per axle at Blue Water, had always been a friction point. Before the tariffs, it was an inconvenience that many carriers absorbed because the Windsor-Detroit route was geographically convenient. After the tariffs, it became indefensible. The policy designed to project strength directly pushed commercial traffic away from the corridor that American private capital had controlled for 9 decades. That is not speculation. That is 531,732 trucks in 3 months choosing the alternative. Now look at who is pushing back against the political pressure on the Gordie Howe Bridge. Not Canadian officials, not trade unions, not environmental groups. Ford, General Motors, Stellantis. The American automotive industry is actively lobbying for a Canadian finance bridge to open as quickly as possible because their own production schedules depend on it. One American economic analysis estimated losses of up to $7 million per week, tied directly to delays in the bridge opening. American companies, American jobs, American production timelines, all being damaged by a political narrative coming out of Washington. The allies are not aligned. They are openly contradicting the position. Then there is the Michigan calculation. Former Republican Governor Rick Snyder, the man who signed the original 2012 agreement, publicly corrected the ownership narrative being circulated in Washington. His message was direct. Blocking this bridge does not protect Michigan. It harms Michigan. The state stands to receive 50% of net toll revenue in perpetuity. It holds joint ownership of a $6.4 billion asset. It contributed zero construction funding to build. Preventing its opening does not strengthen America's hand. It surrenders a long-term revenue stream that was freely negotiated and formally approved. And while this political friction plays out, one entity is quietly recording revenue at levels it has never seen before. The Blue Water Bridge, a publicly owned crossing, capturing the commercial volume that the tariff pressure and the toll pricing drove away from private American-adjacent infrastructure. The strategy aimed at leverage-produced displacement. The displacement produced record earnings for a Canadian public asset, and the American private toll bridge at the centre of the original monopoly is watching its market share erode with no structural mechanism to recover it. The boomerang does not announce itself. It just lands. This is the part where some people change the channel, because when the conversation moves from geopolitics to grocery bills, from bridge tolls to mortgage payments, it stops feeling abstract. And I understand that discomfort. But I need you to stay with me here, because the distance between a truck crossing a bridge in Windsor and the price you paid for your car last year is not as far as you think. Let us follow the chain. Every vehicle assembled in a North American plant, whether it carries an American badge or a Canadian one, moves components across this border multiple times before it becomes a finished product. Engine parts cross, transmission components cross, battery modules cross. The integrated manufacturing model that built the Great Lakes industrial economy was designed around the assumption of frictionless, predictable, low-cost border movement. When that assumption breaks down, the cost does not disappear. It transfers into production timelines, into inventory buffers, into the sticker price sitting on the dealership floor. The average price of a new vehicle in the United States has increased by thousands of dollars compared to pre-disruption baselines. That increase does not have a single cause, but supply chain friction, tariff-driven input costs, and logistics uncertainty are embedded inside every one of those additional dollars you are now being asked to pay. Now extend that logic beyond vehicles. The 50% tariff on Canadian steel and aluminum does not stay at the border. It moves through every downstream industry that uses those materials. Construction costs rise. Appliance prices rise. Infrastructure project budgets expand. And every dollar of additional cost that enters the system at the industrial level eventually finds its way to the consumer level. It always does. The only question is how long the journey takes. If you are living in Michigan, Ohio, Indiana, or anywhere within the economic radius of the Windsor-Detroit corridor, this is not a distant policy debate. The unemployment rate in the Windsor-Sarnia region is sitting at approximately 10% under the strain of automotive sector disruptions. Those are suppliers. Contractors, logistics workers, people whose spending power directly shapes the regional economy you operate inside. And if the Gordie Howe Bridge remains politically contested, if the corridor continues operating below its designed efficiency, if carriers continue absorbing uncertainty costs that eventually flow downstream, the pressure on your cost of living does not stabilise. It compounds. The bridge is not abstract. The bill is already in your mailbox. So where does this go from here? Let me give you 3 scenarios, not predictions, not guarantees, But the three most structurally logical outcomes, based on everything the data, the timeline, and the economic incentives, are telling us right now. The first scenario is the cooperative reset. The Gordie Howe Bridge opens before the end of 2026. The political noise from Washington fades under sustained pressure from American automotive manufacturers who cannot afford another quarter of supply chain disruption. Three crossings compete on price and efficiency. Toll rates across the corridor compress. Carriers benefit. Consumers see marginal relief in vehicle and goods pricing. The 90-year private monopoly is permanently broken. Canada recovers its investment over decades, while Michigan collects half of every dollar the bridge earns. Both sides win. Nobody in Washington calls it a win for Canada, but the numbers will show exactly that. The second scenario is the prolonged standoff. Political pressure from Washington succeeds in delaying the Gordie Howe Bridge into 2027 and beyond. Canada responds not with confrontation but with acceleration. Trade diversification toward European and Asian partners intensifies. The Pacific corridor through Prince Rupert gains investment. The Windsor-Detroit corridor slowly loses its status as the irreplaceable centre of continental commerce. American manufacturers begin making long-term location decisions that account for border unpredictability. Jobs do not disappear overnight, but they stop arriving. And a decade from now, the map looks different in ways that no single policy reversal can undo. The third scenario, and the most likely one, is the quiet resolution. The bridge opens late in 2026 under the weight of economic reality rather than political goodwill. Volume redistributes across three crossings. The Ambassador Bridge loses another 15 to 20% of its commercial market share and begins a managed decline that its private owners will resist loudly and lose slowly. The broader trade tension between Canada and the United States continues without escalating into full rupture, and the corridor finds a new equilibrium shaped entirely by cost, efficiency, and reliability. Not by politics, by trucks making decisions every morning. And that brings me to the question I want to leave with you. For 90 years, a private family collected tolls on the most important commercial gateway in the Western Hemisphere. Two governments spent $6.4 billion to build an alternative, and a sitting administration tried to stop it before it opened. None of that happened by accident. So ask yourself this. If the most powerful nation on earth cannot control which road its own trading partners choose to use, what does power actually mean in a world where supply chains are the real borders? Think about that and subscribe, because the next shift is already in motion, and it is going to be bigger than a bridge.